So in this video, I want to talk about the risk associated with buying or investing in the stock market. So just like investment in the bond market, right? Buying stocks involves greater risk than putting your money in a savings account. Okay, so in general, we talk about from the demand side of money, right? Corporations they issue stocks to raise funds or raise money to finance their business expansion. So on the supply side of money, stock investors, right? Why do they buy stocks? Why do they invest in the stock market instead of using that amount of money in other places? So stock investors or stock buyers, right, are hoping to make money by holding stocks. So in general, for most people, for most stock investors, right, they hope to buy stocks at a lower price and then later they can sell them at a much higher price. So for example, if you have bought Amazon stock 6 months ago, right, 6 months ago, half a year ago, you paid roughly $1,800 for each share, but right now you can sell each share for roughly $2,400. So that means for each share of Amazon stock over the past 6 months, right, you have made almost roughly that would be $600 just for each share. So imagine or thousands shares of Amazon stock, right? So that means you have made tons of money over by holding Amazon stocks over the past 6 months. On the other hand, if you have been holding United Airlines stocks, right? So you may have suffered a major financial loss. So 6 months ago, each share of a United Airlines stock is valued or worth $90, but now it is only worth $25. So that means for each share of UA stock you have been holding over the past 6 months, right? You have lost roughly $55 per share. Imagine if you own thousands of UA stocks, right? You have suffered a major financial loss. So buying stocks or investing in the stock market is risky. You can make lots of money over a short period of time. You can also lose lots of money over a short period of time. So it's very risky. And also stock price fluctuates, right? Fluctuates depending on supply and demand. And also why people's opinion varies on this particular stock. So if people view Amazon more favorably, right? So they want to buy more Amazon stock. So we'll have an increase in demand for Amazon stock, resulting in a stock price rise. Okay, so stock prices are affected by different types of news. So you don't have to be a genius to learn how to invest in the stock market. You can buy stocks as a layman. You can invest in the stock market by basically knowing nothing about how the stock market works. As long as you know the stock price in general is going to rise following some good news about this particular company or about the general economy. On the other hand, the stock price is going to fall following some bad news about this particular company or about the economy. But basically, there are two types of news or two types of risks. One type of risk in the stock market is called the market risk or systematic risk. That's the kind of news, right? It's going to hurt almost all those stocks traded in the stock market. So for example, if you heard, suppose today Russia just invaded Ukraine, right? Or Russia just invaded Poland or Finland or other European countries, right? This piece of news is interpreted as negative because it's a war that started the invasion, right? And this piece of negative or bad news is going to hurt basically most stock prices traded in the world. So this type of risk, war, major disaster, pandemic, right, is called a market risk or systematic risk. So that is why over the past 2 months, right, American stock markets have suffered greatly following the outbreak of the coronavirus pandemic. So the outbreak of a coronavirus pandemic causes a major market risk or systematic risk to global stock markets. So this is one type of risk. There's another type of risk called an idiosyncratic risk. So for example, you may hear another type of news. So for example, if today a pilot working for the United Airlines, right? This pilot just went nuts, beating up a passenger seriously, right? This is bad news. This is bad PR for United Airlines. But this piece of bad news only hurts one particular company called United Airlines. So if the UA pilot beating up a passenger and this piece of news became public, everybody knows, right? So this is going to seriously hurt UA stock price. So United Airlines stock price is going to fall following the report of this negative news. But the UA pilot beating up passenger, even though this is bad news, this hurts UA stocks, right? But using common sense, most people would agree this piece of bad news won't hurt or won't do anything to Amazon, won't do anything to Starbucks, won't do anything to not even Delta Airlines, right? So this type of negative news or this type of risk is only going to affect a particular company or a particular or smaller group of companies, right? So this type of risk is called the idiosyncratic risk. Okay, but what's the problem? So you should, in general, stock prices are going to rise following good news and start to fall following bad news, right? As long as this piece of news is public, it is a fair game for all stock market investors. But the problem is we have so-called insiders, right? They know either the good news, the bad news about a particular company, a particular sector, or the general economy before the general public. So for example, the CEO or top executives at Amazon, right? They may know something serious, something bad is going on within Amazon, but the general public are not aware of this fact. So that means those insiders at Amazon, they know once this piece of news becomes public, their stock price is going to fall, right? So those insiders, those top executives, right? What they can do, what they would do, they will sell their own Amazon stock shares, right? Before this piece of bad news becomes public. So that means they have cheated in the market. So this type of behavior is called insider trading, which is illegal. And trading stocks, or in general, the financial markets are regulated by a US federal government agency called the US Securities and Exchange Commission, for short SEC. So SEC investigated the so-called insider trading in the stock market to ensure that stock market investment is a fair game to all investors, to all stock buyers.